Today's Talk About It Tuesday question is: foreclosure filings nationwide surged to 228,000 in the first half of 2026, marking a 21% increase year over year and the highest level seen since 2019. This upward trend indicates growing financial strain for some homeowners. People are over 4 months behind and over leveraged on mortgages. What does this say regarding where we are in the housing market cycle? And do you expect it to be a buyer's market for investors in the near future? Okay, so I think that people, especially people who are not fully experienced in real estate, are seeing what they perceive to be a repeat of the cycle that happened during the Great Recession. And I'm old enough and have been investing long enough to have experienced the enormous bubble that happened right prior to. So I started investing really heavily in 2004. So 2004, 2005, 2006, you can make money hand over fist in real estate, and the growth was enormous. But we have to look at why. So why did that happen? Lending standards changed. So the criteria for qualifying for a mortgage changed, meaning they opened up what we call a subprime market. People who had never been qualified before all of a sudden qualified for a mortgage, which means that there are more buyers on the market than inventory. And then on top of that, lenders started offering 100% financing, meaning you didn't have to pay a down payment anymore. You just had to cover your closing costs, which brought in more potential buyers into the market. And then lenders came up with 106% financing, which meant your closing costs were also covered, which means there was $0 out of pocket. And when I say you didn't really have to qualify, it was stated income. Whatever you wrote down, you didn't have to prove it. If you said I qualify by putting numbers down on paper, you got approved and you got 106% financing, meaning there was nothing out of pocket. Anybody could buy a property. So of course that brought in far more buyers than there was inventory and put so much pressure on the market that it drove prices up really fast and really high. So that was a real buyer's market. Well, actually, it was a seller's market at that point, because prices were just going up, 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 up. But it was easy money. Of course, that was unsustainable. People who didn't qualify and were paying far more than what a property was worth, buying it at 106% financing, upside down, and some of the structure of a lot of the loans that were really terrible because they were adjustable rates, so they were fixed at a certain point, and then all of a sudden the interest rates went to something enormous. Your payments really exceeded what you were able to pay. It caused the market, that and other pressures caused the market to crash. So in 2008, when we saw the market crash, so 2008 to 2011 was the Great Recession, we saw massive amounts of foreclosures. We saw so many foreclosures, and banks stopped lending, that only people with cash really could buy properties. And the banks were taking back so many properties that weren't selling at auction that they were bundling the REOs, right? That's what you call a property that comes back to the bank. They were bundling REOs and literally selling them at pennies on the dollar. That was a real buyer's market. And so I guess now we're trying to compare this surge in foreclosure filings to the surge in foreclosure filings we saw during the Great Recession. But let's compare. So 228,000 filings in the first half of 2026, and the greatest amount since 2019. So let's look at why. Let's look at the why in that. What happened in 2020? COVID happened. What happened? People couldn't work. So the government and the banks responded. So there was government intervention, right? So foreclosure actions were stopped, courts were closed, There were forbearances offered by banks. There were loan modifications offered by banks in 2020. That stopped foreclosures. A lot of those protections now are over. And so now, of course, you're seeing increased foreclosure filings. Of course, the most since 2019, because there was a long pause. But when we look at the numbers, 228,000 in the first half of 2026. That's halfway the year. In 2010, at the height of the Great Recession, we saw 3.8 million filings, foreclosure filings. One in every 45 housing units in America had a foreclosure action against it. So we're not even talking with, again, 228,000, that's less than a million. If that number holds true for the second half of the year, you're talking about less than a million foreclosure filings compared to 3.8 million foreclosure filings. That's not even close. It's not even alarming when you look at it in that way. And also, again, we have to look at the why. So, is there an affordability crisis right now? Absolutely, right? Because surging prices in other areas, whether you're talking about fuel or food or basically the cost of living, have some people struggling to be able to pay their mortgages. Also, in addition to that, people have uh, other debt, consumer debt, whether you're talking about high credit card debt, which is really high right now. Student loan protections got taken away, so people all of a sudden have to pay student loans. So there are all these other debts on top of that. So yes, we are seeing some people struggling to pay their mortgages. So yes, we did see an increase, but not an alarming increase like we saw before. And then we have to also look at. So the question is a seller's market coming? I would say we're moving to a more balanced market, right? I wouldn't say it's a seller's market or a buyer's market, and here's why. We cannot look at, unless there's a big national crisis like the Great Recession, I don't think we can look at real estate on a national level and say nationally there's a buyer's market or a seller's market. We have to look at real estate ultra regionally. When I say regionally, you can't look at it East Coast, West Coast. You can't look at it even by the state. I don't even think you should really be looking at it by the city in the large metro areas. You have to look at it by neighborhood, neighborhood by neighborhood. And especially as the wealth gap changes or increases, there are certain neighborhoods that will remain stable and solid, and there are certain ones that are super fragile. And any change, whether it's a change in interest rates, whether it's a change in inflation, those fragile neighborhoods will be the ones where you'll see the foreclosures. Those are the areas where you'll see the opportunities as an investor. But others will remain strong. And then you got to look again at regional areas. There's a housing shortage in New York City. So inventory remains low and prices remain high. So does that make it a buyer's market? No, it's hard. It's hard here in New York City to find opportunities and opportunities at a good price because there's so little inventory, and again, so much pressure on the market in terms of few buyers, little, high demand for housing, that this is definitely not a buyer's market in New York City. But if you go to other places, Idaho had a big surge of people who ran there for some reason. Boise, Idaho ran there during the COVID crisis and paid way more than they should have paid because of the sudden demand. And now you're seeing high amounts of foreclosures in Idaho. We're seeing high amounts of foreclosures in Florida, parts of Florida. So regionally, we're seeing these big surges in foreclosures, but we have to look at the reasons too. You look at Florida, prices for insurance have gone up. Anywhere where you have changing weather patterns, right? It's different, right? You start to see all these different reasons why you have foreclosures that are not even connected. And so it's not a national thing. So I have to say, I cannot say that it is a buyer's market or a seller's market. I say balance because regionally you'll see some areas where you can get great opportunities because industries have left and so value's gone down. You'll see places like Baltimore who remain steady because inventory is still high and the infrastructure is horrible and the industry hasn't come in. You'll see areas like New York City that are extremely difficult and sellers are still making off better than buyers. You'll see places that have been struggling for a long time, like Philadelphia and Detroit, where there's still opportunity, but industries haven't caught up to make it profitable. So you have to look at not only a cheap house, right? Because there are places where you can buy a house cheap, but is there also opportunity for you to profit, right? It's not always about getting the lowest price. It's also about cash flow. Can I make money from that? And when there's a lot of inventory, you definitely can't flip. So there's no market for that. So you have to look at, is it a good rental market at a good price? Is there, so you have to look at other factors. So whether it's a buyer's market, seller's market, it's ultra regional. But even again, just because you can get a house cheap doesn't mean it's a good investment. It's not a good deal. So hope that brings a little clarity and some other things to think about. But I'd like to hear your thoughts on it. Please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.